This LOS is explain and evaluate how finance leases and operating leases affect financial statements and ratios from the perspective of both the lessor and the lessee. Leasing. When a lessee reports a lease as an operating lease rather than a finance lease, it usually appears more profitable in early years of the lease and less so later, and it appears less leveraged over the entire lease period. When a lessor reports a lease as a finance lease rather than an operating lease, it usually appears more profitable in early years of the lease. So now we're going to look at some of the differences with regards to the balance sheet and income statement and some of the ratios between a finance lease and an operating lease. So when you have a finance lease, the lessee is going to take the asset onto their books. So assets equals liabilities plus equity. If you have the asset on your books, your asset is going up and your liability is going up, okay? So your assets are higher under a finance lease versus an operating lease where they're lower. So as I said, if your asset's going up, your liabilities are going up, so your liabilities have to be higher, okay? And then when I have the asset on my books, the way to look at it's pretty easy to understand, in fact. It's like the lessor is giving me a loan to purchase, okay? So I have interest expense for example, because I've borrowed money, and I have the asset and I have a depreciation expense. So I have interest and depreciation, okay? So that means my net income in the early years is lower than an operating lease. And the reason is because the depreciation and interest expense in the early years is greater than the operating payments. But what happens with a loan over time? With a loan over time, the interest rate decreases, okay? The interest expense decreases over time. So in later years, the depreciation and interest is less than the operating payments. So in the early years, the net income on a finance lease is lower, but it crosses over and it's higher in the later years. The total net income over the life is the same. It's just a timing issue, okay? Cash flow from operations is higher under a finance lease, lower under an operating lease, because with a finance lease, the payment is split between principal payment and interest payment, where in operating lease, 100% of the payment is cash flow from operations, okay? So we're going to have a lower cash flow from operations with an operating lease, which I think is easy to understand. It's 100% like a rent payment, okay? The cash flow from financing, though, is going to be lower with a finance lease and higher for a operating lease for the exact same reason. But the total cash flow is going to be the same. So again, that's just a classification issue. So again, in summary, the way to think of a finance lease is that as the lessee, I need to take the asset onto my books. So assets equals liabilities plus equity. If I have the asset on my books, my asset's going up, my liability is going up, okay? And I'm being financed. I'm making annual payments for 5 years, 10 years. So those payments, just like a mortgage or a car payment, have got an interest component. I'm paying back principal, I'm paying back interest. The total amount of the payments is going to be more than the initial value of the asset, okay? Because I'm paying interest. So in the early years, I have depreciation expense and I have interest expense, okay? And that's going to be greater than an operating payment, which is just like a rent. But interest comes down, interest expense comes down as the loan is ground down. So in the later years, I'm going to have a higher net income versus a operating lease, okay? So it takes a little bit of work at the beginning to understand the leases, but at the end of the day, it's not that hard. Just think a finance lease, I've got the asset, A goes up, L goes up. Oh, I've got the asset and I'm borrowing money to get it, so I've got depreciation and interest. That's more than a rental expense. So moving on now to look at some of the ratios for the lessee, and these are from the lessee's point of view. I've got the asset on my books equals liabilities plus equity. So as I've said, my asset's gone up and my liability's gone up. So you can see, always look at your numerator and denominator, what's happening. My asset turnover is going to be lower because my assets are higher, okay, under a finance lease. So under an operating lease, my asset turnover is going to be higher. Return on assets, okay, as I've mentioned before, and I'll mention again, As goes the net income, so goes the ROA and ROE. So in the early years, as I said, you've got that interest and depreciation expense, which makes my expenses higher than an operating straight out rent in the early years. So my net income is lower. That means my return on assets is lower in the early years. Similarly, my ROE is going to be lower, okay, in the early years. My debt to assets is going to be higher. Why? Look at my debt. My liabilities has gone up. Even though my assets and my liabilities has gone up, my debt to assets is going to be higher under a finance lease. And my debt to equity is going to be higher as well because I've got the higher debt. So again, down here, I've just a little bit reminder. Assets equals liabilities plus equity. Finance lease, increase A, increase L. Early years, the finance lease, the net income is less than the operating lease, so the numerator is a smaller percentage. Denominator, big for ROA. Lower net income is lower ROA, lower ROE. And that's the last slide for this LOS. Thank you. So we're just going to walk through some of the accounting now with regards to the lessee, okay? And so this is the example in the text. I'm using the exact same numbers. And by the way, these numbers never changed since 2001 when I studied the CFA Level 1, except that they changed the dates, they updated the dates, and it used to be in US dollars and they changed it to euros, okay? So the example is Cap BS, that's capitalized balance sheet, because the asset's going to show up on the lessee's balance sheet, so it's being capitalized. Enters into a lease agreement to acquire the use of a piece of machinery for 4 years, beginning on January 1st, 2010. The lease requires 4 annual payments of 28,679 euros, starting on January 1st, 2010. The useful life of the machine is 4 years. Its salvage value is 0. Cap BS accounts for the lease as a finance lease. The fair value of the machine is 100,000 euros. The present value of the lease payments, using the company's discount rate of 10%, is also 100,000 euros. A reminder is relevant for the present value calculations. Lease payments are made at the beginning of each period. The company uses straight line depreciation. Okay, so up here we have a little bit of a table, and I'll just cross it off. We'll start first with the easiest part. So the lessee, it's a finance lease, so the lessee is going to take the asset on the books. Assets equals liabilities plus equity. They've got the asset, okay? The asset's going to increase, the liability is going to increase with the lease liability, okay? So we're going to debit asset 100,000. We're going to credit the lease liability 100,000. That's our debits and credits, okay? So we've got the asset, we need to depreciate it. So it says 100,000 minus 0 salvage value divided by 4. They're using straight line depreciation. The depreciation expense every year is going to be 25,000. So let's get that calculation out of the way quickly. You can see that's a very easy one. There should be no issues understanding that at this point. So we can see that at the end of year 1, we've got the net book value 75,000, 50,000, 25,000, and at the end of year 4, we don't have the assets been fully depreciated, okay? So the next thing, we need to look at the accounting for the lease and with regards to the payments. So let's start here, the beginning of 2010. The liability is 100,000 euros, okay? And it says that the payments, there's going to be 4 equal payments of 28,679. I did a little bit of rounding. I've got 2 decimals there, okay? So the first thing that, if you look at, I got a piece of equipment that's 100,000, but I'm paying back 114,717 euros, okay? So why is that? Because as we've said, a finance lease is just like borrowing money from the lessor, not from a bank. So I'm paying back, to pay back the loan, 100,000, and some interest. And the interest is at a rate of 10%, okay? So we can see that if the liability is 100,000 and I paid 114,717, then I've got interest. It's going to be 14,717 in interest, okay? So what happens here then, this table, if you've been familiar, so we're getting into leases. Some students say, well, it's kind of difficult to understand, but if you've ever done a loan amortization table, which a lot of students have done in basic accounting courses at lower college or university levels, this is just a loan amortization table. We start with 100,000, but in this case, the payment is made at the beginning of the year. So 100% of that payment goes to reducing the reduction of the liability. So our liability at the end of the year is $71,320.84. That becomes our liability at the beginning of the year. Payment never changes, but now I've got some interest. Where did that interest come from? Well, I made this payment right at the beginning of the year, so this was my liability for the entire year times 10%. The interest rate was 10%. So you can see that it was my interest from the first year. So this table up here is cash flows, okay? But down here you can see in year 2010, I would have had an interest expense. I would have had an interest payable at the end of the year, correct? I would have had my depreciation expense, and I would have had debit interest expense, credit interest payable. Then in 2011, when I make that payment of $28,679.16, that means $7,132.08 is for the interest. The remainder is for the principal, and therefore the liability comes down to $49,773.76, which, don't forget, that's my liability. These payments are being made at the beginning of the year, so that's my payment that's my balance at the beginning of the year, $49,773. Okay, so that's why the interest is $49,777.38. So you can see there's just a timing issue. These are cash flows up here. Okay, this is cash flows with regards to the actual payment. But down here is my accounting on my income statement. I'm going to have depreciation expense every year of $25,000, very easy to understand. And then I'm going to have an interest expense, also fairly easy to understand, $100,000 liability at the beginning of the year, paid the first payment. That means I had a balance of $71,320 since the beginning of the year, times 10%, I've got an interest expense. So there's my total expense with regards to a finance lease. So what we've mentioned before in the previous slides, you can see that with any loan, as I pay off the loan, more and more of the loan, the principal comes down, the interest comes down, and this is the whole point with regards to the early years and the lesser years, that you can see in the final year, I don't even have any interest expense, okay? So my expenses with regards to the lease are coming down. They start at $32,132.08, and they end at $25,000, okay? So you can see in the early years, that's more than the operating payment of $28,679, and at the end of the lease, it's less. So that's why in the early years, a finance lease is less profit. It's more expensive, lower net income than an operating lease. But in the later years, it's more profitable. That's what we looked at in the previous slides. Okay. So again, this is not too difficult to understand. Just remember, in summary, when the lessee takes on a finance lease, they've got the asset, they've got the liability. Asset goes up, liability goes up. So 2 points. Let's start with the asset. We need to depreciate it. We're going to have a depreciation expense every year. Second thing, we've borrowed money. We're going to pay the lessor more than the value of the asset because we're including some interest. So we've got an interest expense every year. Okay. As the loan gets paid off, the interest expense starts to decrease. So the expense will go down over time with regards to a finance lease. Okay, the reason why I put it into Excel is that you can put it side by side a little bit easier than in the text. The numbers are kind of spread out over a couple of tables and a couple of pages. It's hard to go back and forth and compare. So here on this slide, I'm going to look at the income statement. The next slide, I'm going to look at the cash flows. Okay. And this is from the point of view of the lessee. So here we have the Cap BS, which is the capitalized balance sheet. And here we have Opus, which is the operating, if it was just a operating lease. And so we can compare the two side by side. And the first thing that I'm going to start with is that you can see the total net income over the 4 years is the same, regardless as if it was a finance lease or an operating lease. And that's mentioned in one of the first slides, is that the cash flow and the net income over the term is the same. The next thing that I'm going to show is that a reminder that the net income in the early years for the capitalized lease, because I mentioned we've got the depreciation and the interest, which is more than just the lease expense, the rental payment in the early years. So our net income is lower on the finance lease than in the early years, okay? So now this is giving a nice comparison, because on the previous slide, we went through the calculations of how we got that interest of 713208, 4977.38, and 2607. There's our interest, the 14716 over the 4 years, okay? We understand that. And there's our depreciation expense as well over the 4 years, the 100,000. So if we start now with the income statement for the capitalized balance sheet, this sales 50,000, that's just a made-up number. So we know that if I'm capitalizing it, I've got the depreciation expense. We saw that on the previous slide. Then I've got my interest expense, which is going to give me an EBIT. I'm going to have a tax, and then I'm going to have my net income. Over here on if it was an operating lease, I'm going to have the same sales, 50,000 euros, no depreciation. I don't have the asset on my books, okay? But I'm going to have a lease expense. I'm renting here, I'm renting it. And it's going to be the same payment every year, the 28,679. So again, I have the same total, 114,716, and the same net income over time. But my income statement, I'm going to have higher net income in the early years and lower net income in the later years, okay? And I'm going to have higher tax in the early years. Actually, my tax doesn't change, okay? My tax doesn't change. Here I've got lower tax in the early years and higher tax in the later years, okay? My tax doesn't change. And you can see that's one nice issue, is that with an operating lease, all my numbers don't change because I'm just paying the exact same amount of rent every year. So my net income is the same, my tax is the same. It's a fairly easy income statement to understand. So the key thing is, as I said, the main thing is with the finance lease, you just have to understand I've got the assets, so I've got the depreciation, but I've borrowed money, so I've got some interest expense. The interest expense grinds down over time, it becomes less. So my net income in the early years is less than an operating lease, and it's higher in the later years. But in sum total, my net income over the 4 years is exactly the same. So now we're going to look at the cash flows from the point of view of the lessee again. At the top, we have the capitalized balance sheet. So this is the finance lease. And below, we have the operating lease. Okay. So we can zoom in on a couple of things right away, just to get that out of the way. We can see that both the total change in cash is the same. It's just a timing issue once again. Same thing with the net income. It was the same over the total for the 4 years between the finance lease and the operating lease. The net income was the same. Same with the cash flows, okay? But there's timing issues and there's categorization issues. So up here we've got in the operating cash flows and we have the financing cash flows. So let's start with the easier one, get it out of the way. If we look at an operating lease, we're not going to have any financing cash flows. It's just 100% rent payment. 28,679 was our annual payment every year for 4 years, okay? And as I said, the operating lease is nice to understand because the payment's the same every year, so my taxes are the same, my net income is the same, and my cash flows are all the same. So that's why I said if you understand the operating lease, it should be easy to understand, okay? So that is, and again, that lease expense, that rent expense, is all coming out of operating cash flows. So that's the thing to realize, is that if I compare my operating cash flows up here on my finance lease, they're going to be higher than on an operating lease. Why? Because on my finance lease, my cash flows are split between the interest paid and the payment to reduce the lease liability, which are classified as a financing cash flow, okay? So that's the key thing to understand. I think it's pretty easy to understand the operating cash flows. It's just a rent expense, okay? And it's the same every year. So my operating cash doesn't change, my net income doesn't change every year, and it gives me a total that's the same as the finance lease. But with regards to the finance lease, as we've mentioned, we're going to pay less taxes in the early years, more taxes in the later years. We're going to pay more interest in the early years and less interest in the later years, okay? But cumulatively, we're going to end up in the same place. And on a finance lease, my cash flows are split between interest, so my operating and financing. So my operating cash flow is higher than an operating lease. Another nice thing about putting into Excel is that I did a couple of graphs here, because sometimes people say a picture's worth 1,000 words. And again, this is from the point of view of the lessee. These are my graphs. They're not in the text. And I just wanted to show you that the ROE on an operating lease starts higher than on the finance lease. So you can see blue is the capitalized balance sheet, red is the operating, and they cross over. And so there's quite a few potential questions that they could ask you about the early years, later years, most likely. And so I like to just draw a little graph like that. And we know that the ROE on the capitalized is lower in the early years. Why? It's easy to understand. I've got depreciation plus interest, and that's more than just the straight operating rental payment, because my interest starts higher and it grinds down over the lease, okay? And again, as goes my net income, so goes my ROE, okay? And then, of course, the operating cash flows are higher on my finance lease than on my operating lease, because this is 100% rent. So that's just a couple of graphs that I did, because sometimes people can improve their memory skills by drawing a little bit of a graph and then remembering, oh yeah, that's the finance lease. It's lower in the early years than in the, so this is years and this is percentage. Lower in the early years, higher. Why? I understand why. And then I can answer any type of question that they've given me, most likely, least likely, early years, later years, etc. Okay? Just do a practice question to check our understanding. A capital lease requires annual lease payments of $2,000 at the start of each year. Fair value of the leased equipment at inception of the lease is $10,000. Implicit interest rate is 12%. If the present value of the lease payments equals the fair value of the equipment at the inception of the lease, the interest payment in dollars in the second year of the lease is closest to A, $960, B, $1,104, or C, $1,200. Okay, the correct answer is A, $960. So all we need to do is set up our amortization table, and we know the starting balance is $10,000. The payment is made at the start of each year. So when you make that first payment of $2,000, that's going to reduce the principal. So I have a balance of $8,000. That says ending balance at the end of the year, but that's the balance for the whole year times 12% is going to equal $960, okay? So that's going to be an interest payable, interest expense in the first year, but with regards to the cash flow, when I pay that $2,000, $960 is going to be for my interest expense. That's the interest payable, and the rest will decrease the interest, will go against the principal. So 2,000 minus 960, we would fill that in as 1040 here, okay? And therefore, our ending balance then on the liability, I'm just filling this out. You don't need to know this, but I mean, you don't need to do this for this question, but it's just a little, using that as a little bit of a review, plus my 8,000, and we can see that the balance is 6960, okay? So I could write here 6960, and then my interest would be 6960 times 0.12, and that would equal 835.20. So we can see our interest is coming down, 835.20, and 6960 we can carry along with the table. It's just a loan amortization table, folks. So that's just another quick little review. Shouldn't be too difficult. Now we're going to look at the lease from the point of view of the lessor, okay? And this is not too difficult because it's just the exact opposite from the point of view of the lessee, okay? So just a quick review. If it's a finance lease for the lessee has the asset, so the assets are going to be higher. From the lessor's point of view, it's going to be lower, okay? If it's a operating lease from the point of view of the lessor, the asset is still on the lessor's books, so their assets are going to be higher, okay? So if I've got the higher assets, again, assets equals liabilities plus equity. If I've got the higher assets, I've got the higher liability. I've got the lower net income in the early years. I've got the net income in the later years is going to be higher. Total net income over the life is going to be the same. Cash flow from operations is going to be higher on an operating lease. And my cash flow from financing is going to be lower. Of course, here I'm getting paid back my principal, so my cash flow from financing is going to be higher, okay? Because it's a finance lease. The lessee has the asset, and I'm getting back my interest and my principal, so my cash flow from financing is going to be higher than on an operating lease where I'm just collecting a rent payment. And again, it's the same story that the total cash flows over the 4 years is going to be the same, okay? And the total net income over the life is going to be the same. It's just going to be a timing issue. So just carrying on now with some of the ratios from the lessor's point of view again. So always go back to assets equals liabilities plus equity, and just remember where that asset is. So from the lessor's point of view, if it's an operating lease, they still have the asset on their book, okay? So the higher asset, you're going to have lower asset turnover. The return on assets is going to be lower, okay? Return on equity is lower because remember, I have the lower net income in the earlier years, okay? And my debt to assets is going to be higher. My debt to equity is going to be higher. So remember, if it's a finance lease, I don't have the asset on my books, okay? And so it's the opposite. I'm going to have the higher asset turnover and I'm going to have the higher return on assets in the early years, the higher ROE, lower debt to assets, lower debt to equity. So now we're going to do the same type of analysis. We're going to look at the income statement, cash flows, and some ratios, but we're looking from the point of view of the lessor, okay? And here I've got it in the income statement first, if it's a finance lease or if it's an operating lease. Let's start with an operating lease first. So if it's an operating lease, from the point of view of the lessor, I still have the asset, correct? Assets equals liabilities plus equity. I still have the asset, so I have the depreciation, okay? And what is the lessee doing? The lessee on an operating lease is just giving me the same yearly payment every year, so that is going to be a lease revenue. That's a rent, okay? Because it's an operating lease, okay? So that's why I said let's start with this one because it's easy to understand. The payment is always the same, and my depreciation is the same. So we can see my net income is the same every year under the operating lease. And the cumulative total is 150,301.2, which is exactly the same as the cumulative total over 150,301. Well, a little bit of small rounding there with regards to the finance lease. Okay, so again, that's the key point. The net income is the same. Now here we can see, as I mentioned, on the operating lease, it's just $28,679 a year every year for 4 years. That's a rental payment. Okay. But as we move up here to the finance lease, what's happened? I'm the lessor. I own the asset. I may not have transferred the title, but I don't have the asset on my books anymore. It's gone to the lessee. Remember? The lessee has the asset because it's a finance lease. So I don't have any I don't have any depreciation. What do I have? I've got interest revenue, okay? I've got interest revenue. So you can see in the early years, because down here we've got depreciation, in the early years, I've got the higher net income on the finance lease because remember, from the lessee's point of view, the net income was lower in the early years because I've got the interest and the depreciation. So here, I've got no depreciation. I've got the interest revenue, okay? So I've got the higher net income in the early years and it's lower in the later years because my interest revenue is grinding down. And sum total is going to be exact same. And there's that interest number again, the 14,716.66, 100,000 for the equipment. But because it's a finance lease, I've lent the lessee the money. They're paying me back principal and interest. How much was that interest? 14,716.66. Down here, the total that was just included as a rental payment, 28,679 every year for 4 years. It's going to add up to be the same, 114,716. Up here, though, it's an interest, 14,716, and it's going to be, when we look at the cash flows, a repayment of the principal of what you could call a loan for 100,000. Now we're going to look at the cash flows from the point of view of the lessor between a finance lease and an operating lease. Again, let's start with the operating lease because it's maybe a little bit easier. Okay, so we know that the cash flow is going to be the exact same every year, and the total is $253.01. Okay, and so we've got our net income, add back our depreciation. There's our operating cash, and we can see our operating cash flow under an operating lease is going to be higher than under a finance lease. Why? Because with the finance lease, I'm going to be receiving payments, and those are the payments received on my lease. That's going to be categorized as investing cash flow. So you can see in the first year, 100% of that first payment was paying back the liability, but then I'm going to be collecting interest, and the rest of the payment is going to be paying back the principal. So you can see the $100,000, the investing cash flows, I'm getting my $100,000 back. Okay. The interest is included in my net income, don't forget. All right. So the investing cash flows on a finance lease, of course, I'm going to get my $100,000 back. Here on an operating lease, no. It's just a rental payment. So of course my operating cash flows under a finance lease, under an operating lease, from the point of view of the lessor, are going to be higher than under the finance lease. Same type of analysis here. We've got the net income on the direct finance lease and the net income on the operating lease. We can see on the finance lease, the net income is lower from the lessee's point of view in the early years. So it's higher from the, I don't have the asset on my books because I'm the lessor on the finance lease. So my net income is higher in the early years. So therefore, my ROE is going to be higher in the early years. It's the exact opposite, okay? And you can see with regards to the operating cash flows, of course, it's a finance lease. I'm getting paid back principal and interest. So my operating cash flows from the point of view of the lessor are going to be higher under an operating lease, okay? And again, there's going to be a crossover because it's the same pattern. Later on, the operating lease is going to have the higher net income. The operating lease is easy to understand that net income never changes, but here the interest payments are coming down, so my net income from the point of view of the lessor is coming down. So in the later years, my ROE is going to be lower on the finance lease than on the operating lease. Again, a picture's worth 1,000 words perhaps. Start with the net income. So we can see the net income on an operating lease is lower in the early years. It's higher on the finance lease because remember, just always start with one. If I like to start with the lessee and then to flip it to the lessor, I'm just thinking the opposite. So that's why I'm saying that sometimes. I know that from the lessee's point of view, in the early years, my net income is lower on a finance lease. So from the lessor's point of view, it's going to be higher, okay? And if I have higher net income, I'm going to have a higher ROE. Now, with regards to the cash flows, of course, this is easier to understand. Now I'm looking from the point of view of the lessor. An operating lease is 100% rent, so my operating cash flows from the point of view of the lessor for an operating lease are going to be much higher. Okay, just did a little table here at the end, looking at the leases. So first of all, we're going to look at from the lessee's point of view. We have the operating lease and the finance lease. We've got the balance sheet, the income statement, statement of cash flows, just a little summary. So an operating lease from the lessee's point of view, I'm not taking the assets, so there's no effect to my balance sheet. I'm reporting a rent expense, and the rent expense is an operating cash flow, okay? Under a finance lease, I'm going to have the asset. Asset goes up, equals liabilities plus equity. Asset goes up, liability goes up. I'm going to have the depreciation expense. I'm going to have the interest expense as I pay back the interest and principal. So on the income statement, I'm going to have depreciation expense on the leased asset, and I'm going to have an interest expense on the lease liability. From the statement of cash flows, there's a reduction of the lease liability as a financing cash flow, and the interest portion of the lease payment is either an operating or financing cash flow under IFRS, but it's an operating cash flow under US GAAP, so that's one little important issue to realize, okay? Now, we've seen that through the example, the summary from the Excel. This is just a little summary table to help with the memorization. Okay, we're down to the last slide for this LOS. It's been a long one, but there's a fair bit to go through on the leases from both the point of view of the lessee and the lessor. Okay, so the last one is just this table, but now it's point of view from the lessor. We're looking at the balance sheet, the income statement, and the cash flows. So if it's an operating lease and I'm the lessor, I've got the asset on my balance sheet. Okay, so I'm going to have a rental income. It's going to be the same amount, and I'm going to have the depreciation expense, and my rent payments received are operating cash flow. If it's a finance lease, then I'm not going to have the asset on my balance sheet. It's going to move to the balance sheet of the lessee, okay? And that's when the present value of the lease payments equals the carrying amount of the leased asset, called a direct financing lease under US GAAP, okay? So we remove the asset from the balance sheet, and we're going to have a lease receivable. We report the interest revenue on the lease receivable, and the interest portion of the lease payment received is either an operating or investing cash flow under IFRS, and it's an operating cash flow under US GAAP. So it's important to remember that you have a choice under IFRS. And of course, the receipt of the lease principal is an investing cash flow. Now, you need to be careful of when the present value of the lease payment is more than the carrying amount. That means the lessor has made a bit of a profit, like on the sale, because the present value of the lease payments is more than the carrying value. In the US, they call that a sales type lease, okay, under US GAAP. In this case, again, the lessor removes the asset. He's going to recognize the lease receivable, and you report the profit on the sale at the time that the lease is signed, okay? And again, it's going to be interest revenue on the lease receivable. And then this section is the same as above. The interest portion on the lease payment received is either operating or investing cash flow under IFRS, and it's operating under US GAAP. Receipt of the lease principal is an investing cash flow. And that's the last slide for this LOS. Thank you.